Hey there, how are you doing? Today's lesson is a purely business English lesson in which you will learn 40 financial terms that will help you develop a feel for finance, communicate effectively, and conduct successful business negotiations with business managers, investors, and finance professionals. Stick around. The first term we're going to look at is asset. An asset is something that has economic value or the power of a company to earn money. We can distinguish three types of assets. Current assets refers to money in the bank, investments that can easily be converted into cash, money that customers owe to the company, or stocks of goods expected to be sold within 1 year. The second type of assets is fixed assets, which refers to a long-term, tangible piece of property, equipment, or machinery that a company uses to generate income. Fixed assets are not expected to be consumed or converted into cash within a year. The last type of assets is intangible assets. Intangible assets are things that are not physical in nature. We cannot see them. For example, goodwill. By goodwill, we mean those assets that we cannot measure directly, such as customer loyalty, the reputation of the company with existing customers, and other non-quantifiable assets. Now, if you are selling a business or company that is financially stable enough to meet its obligations and continue its business for the foreseeable future, and by foreseeable I mean for the next 12 months, you are selling this business or company as a going concern. So your company is not under the threat of liquidation. Liquidation means closing of the business because the company is insolvent, meaning it cannot pay its obligations and its remaining assets are used to pay creditors and shareholders. Another term is liabilities, and these are the company's debts to suppliers, lenders, or the tax authorities or any other entities. Debts that have to be paid within a year are called current liabilities, and those payable in more than a year are long-term liabilities, for example, bank loans. Assets such as machinery and equipment lose value over time because they wear out, meaning they become useless for long or excessive use, or they lose value because they are no longer up to date. This is called depreciation or amortization. For example, when we buy new computers, we depreciate or amortize them over a very short period of time, usually 3 years, and a charge for this is shown in the financial records. The value of the equipment is written down, meaning it is reduced each year and written off completely at the end, that is eliminated from the books altogether because it becomes zero. Depreciation is calculated by subtracting the salvage value or scrap value, which is the estimated amount an asset is worth at the end of its useful life, from the initial cost of the asset divided by the number of years of its useful life, that is the amount of time an asset is expected to be functional and fit for purpose. It is the depreciation formula. The value of an asset at any one time is its carrying value or book value. It is the net worth of the asset that is recorded on the accounting books, and this is how it is calculated. For example, if you bought a computer for 15,000 dirhams and its associated depreciation was 2,000 dirhams per year, then at the end of the second year, the computer would have a book value of 11,000 dirhams. If an impairment charge of 1,000 dirhams were to be applied at the end of the second year, the book value of the asset would decline further to 10,000 dirhams. Another term is balance sheet. The balance sheet of a company is a financial statement that includes its assets, liabilities, and shareholders' equity at the end of a particular period, usually a 12-month period of its financial year. In other words, the balance sheet illustrates the business net worth. Shareholders' equity is what remains when you subtract all of the liabilities from all of the assets. It is also referred to as the company's book value. Another important term is capital. Capital is the money that a company uses to operate and develop. There are two main ways in which a company can raise capital. That is, find the money it needs. It can use share capital or loan capital. Share capital is contributed by shareholders who put up money and hold shares in the company. A share is a single unit of ownership in the company. Shareholders receive periodic payments called dividends, usually based on the company's net profit during the relevant period. Capital in the form of shares is also called equity. As for loan capital, it is money that is borrowed from a financial institution or investor but don't own shares in the company and receive a fixed rate of interest rather than dividends, whether it has made a profit within a specified period or not. The sum of money borrowed is called the principal. Lending to companies is often in the form of bonds or debentures. Bonds and debentures are generally agreements by which an investor lends money to a government or a business for a set period of time, with the promise of repayment of that money by the bond issuer, the company or the government, plus interest. The investor in this case is called the bondholder. Now, for a company to secure a loan, it must have collateral or security. Collateral refers to an asset that the lender accepts as a security for the loan. It may take the form of real estate or other kinds of assets depending on the purpose of the loan. The collateral acts as a form of protection for the lender. That is, if the company defaults on its loan payments, it can't repay its loan, the lender seizes the collateral and sell it in order to get their money back. Many companies have both loan and share capital. The amount of loan capital that a company has in relation to its share capital is its leverage. In British English, it is called gearing. A company with a lot of borrowing compared to its share capital is highly leveraged or highly geared. A company that has too much debt and is unable to make principal and interest payments and to cover operating expenses is over-leveraged. When a company makes a profit, it distributes earnings to shareholders, what we previously called dividends, while the major portion of the profits is kept within the company as retained earnings, which represent the money to be used for the company's ongoing and future business activities. These earnings help the company build up its cash reserves. And in this case, we say that the company is sitting in a cash pile or cash mountain. These reserves may be used for investment or to make acquisitions, that is, buying other companies. Well, this is the end of our lesson today. I hope you enjoyed it, and please, if you did, give it a share. So long.